Hi, everyone. This is Jason Bierk of Wall Street from Main Street.
And Lee Justo from Risk.
Welcome back to another episode of Finance Unspun. This is episode number 12. So, Lee, we had the Fed rate hikes, and this is the fourth time in a row that the Fed has done sizable rate hikes. Jerome Powell tried to, as best as he could, he tried to absolutely squish talk of a pivot. You mentioned, I think, the phrase pain a lot.
Yeah.
And it's not because he's a Washington Capitals fan. he's actually, the Fed actually seems intent now on continuing to crash asset prices. Although the dollar index, Lee, this was kind of surprising. The dollar index didn't have a big move upwards on the news when the rate hikes were actually announced, though.
No, the dollar's somewhat like still coming back down from its all-time high. It's made this is its third trip down, I think. So it'd be interesting to see if it holds here and goes back, or if it continues its decline. And it's not just the Fed that's raising rates; it's central banks all across the world. And I think Bloomberg's predicting that by mid-2023, it's going to reach about 5.5% globally.
No way. I don't think we're going to get to those levels. I think the maximum pain threshold is going to occur before that. Especially for the U.S. government. I mean, Japan is already hitting those limits. Japan's a mess right now. So historically, with governments and central banks, you can either save your government bond market or you can protect your currency, but you cannot do both.
Well, I was thinking a lot about things before this show, and the one thing that really just sticks out to me is the Fed is using inflation as the reason why they're raising interest rates. But if you actually look at inflation from an objective long-term standpoint, the inflation's been going on a really long time, and we've seen it most in the equity markets, the bond markets, the real estate markets. That's where the inflation's been. And it's only been maybe the past year or two where we've actually seen it in consumer goods like fuel and food. And those are actually being driven, I mean, from my perspective, they're being driven more by issues outside of printing of money. I mean, you look at the fuel situation. We've certainly talked about this many times on the show, what's been causing issues. The Ukraine war is a big factor in it. And then that spreads out to lack of nitrogen for the farmers. And, there's been a lot of regulations passed by countries such as Canada, the Netherlands, trying to reduce the use of nitrogen. In fact, in Sri Lanka, they did that, and they just pretty much outlawed all synthetic fertilizers, and it was absolutely devastating to the country. So there's a lot of factors behind all these costs, and the central bank hiking rates are not going to address that. And the CEO of Kraft Heinz, Miguel Patricio, he said that his industry is going to be facing all these issues going into next year, and that's independent of rate hikes.
Yeah, I agree. Central banks, the way they look at things, Kyle Bass has said this, they have a hammer and they see everything as a nail. So they're Keynesians, they're Keynesians or neo-Keynesians. And so they see that they look at the world through a framework of aggregate demand, either increasing aggregate demand when they're trying to inflate asset prices, or when Janet Yellen was saying for years that there wasn't enough inflation, we have to get more inflation. That was to boost aggregate demand. That's what the Keynesians wanted. But now they're trying to kill demand. Now, for 6 months now, we've seen articles out of Wall Street, the mainstream financial media, that job growth, that wage growth was bad. It was causing inflation. So they're saying that, they're saying that that's bad for the economy. But where I'm from, if you're getting a promotion, a wage increase, that's normally good for the economy. So, I mean, what Keynesians have just twisted things tremendously, but a higher oil, natural gas, diesel, electricity prices, these are causing much higher cost of goods sold. As I've been saying now for the last couple of weeks, Lee, the producer price index here in the United States, that has been almost consistently double the phony CPI or changing propaganda index, that is the consumer price index. It's been almost double that number for over 12 months. So producers, people actually make the stuff, businesses, goods and services, cost of goods sold, those costs have been 15, 16% higher for a while. Now with the consumer price index, if the energy prices stay high, it's that will keep the consumer price index higher unless they figure out new ways. But eventually there will be a deflator with it's called base effects, but really it's a deflator where if the inflation is not still rising, they say it's a new normal. So even if you're running a business and your cost structure is, let's say 10, 12, 15, 20% higher, the way these PhD economists gobbledygook these formulas is they say the base effects, it's not increasing by 15 or 20% anymore. It's a new higher cost structure. They say they use a deflator and say that the inflation rate is not increasing anymore, even though the cost structure as a business owner is much, much higher than it was 2.5 years ago.
Yeah. It's the delusion of the central planners thinking they can actually control things, and all they do is mess things up.
Well, they've created this food and energy crisis. Europe's not producing any of their own energy supply. They're going to have to import even more fertilizer. So they don't. The fertilizer companies in the European Union, in the United Kingdom, they don't have cheap natural gas relative to the U.S. and Canada. U.S. and Canadian fertilizer companies have an enormous advantage making fertilizer with cheap natural gas here in North America and then exporting it. So the European Union is going to have to buy even more fertilizer. They're going to have to import it. That's not going to help them run trade surpluses. And then they're not going to buy U.S. treasuries. But it was surprising, though, that the dollar index, we're recording this on Monday night, November 7th, 2022, for our listeners out there who want to know. The dollar index is a little above 110 now. It was surprising, though, Lee, that on the news of the rate hikes, the dollar index didn't have what Brent Johnson, the dollar milkshake guy, I'm friends with Brent. He was a former gold fund manager. He's a really smart guy. I don't agree with everything he says, but he's been predicting what dollar index to 120 or higher. And yet the dollar index did not move when the rate hikes were announced last week. It did not have another big spike higher.
No. And what's interesting is we look at the equity markets, and they've pretty much been on fire past like couple weeks. The transports and the industrials, but the Nasdaq's just dead. It hasn't really moved. I mean, it's
well, the Fed was injecting enormous amounts of liquidity. The U.S. Treasury and the Fed were injecting enormous amounts of liquidity to fool retail traders and kind of cause a relief rally, a bear market rally before the elections. So It wasn't based on fundamentals. It was liquidity.
No, it never is.
They actually stopped the quantitative tightening for 3 or 4 weeks. So there was an attempt at market manipulation prior to the elections to help it out, but then they're going to pull that liquidity out. But that's a good point, though, about earnings. All of these industries, except for energy, so oil and natural gas producers, coal producers, except for energy and utilities, Wall Street analysts, so these are the investment banks that are covering these companies with revenue projections, earnings projections, profit margins, they've had enormous revisions of earnings going forward. So these are like recession or depression type earnings revisions for every industry but 2 industries. While the federal government and the PhD economists say that, they're changing the definitions of what a recession or depression, what a recession is now. but all the signs, my point, Lee, is that we're getting all the signs of a stagflationary recession or depression. I would say depression, because look at the amount of firings out of Silicon Valley. Look at the amount of, you're having asset prices crash. You're having record amounts of credit card debt that the consumer can't pay. And it's not because they're buying expensive trinkets. It's because they can't pay their everyday bills. Their bills are going up with inflation. People are losing their jobs. Their income's not keeping up with their cost of living. Their everyday bills rising. And then you have what the major one, which is surprising a lot of people, is all these layoffs, firings in Silicon Valley, big tech, and China is also having an enormous real estate and technology bust too.
Yeah, let's drill down a little bit on the tech layoffs here. I found a very interesting chart on, I think it's trueup.io, and they basically chart all the companies and layoffs going back to last December. And it looks like the highest number of layoffs was nearly 30,000 back in June. They look like they've pretty much been averaging around 20,000 or so every month since then. November so far, it's 11,000. And I know that Meta just, there's rumors that they're going to be laying off thousands of employees. We know that Twitter, with Elon Musk taking it over, laid off a bunch of people. I don't see this trend
wasn't Facebook
changing.
it was leaked over the weekend that Facebook and Meta was supposed to lay off thousands of people too this week.
Yeah, I just said that. Yeah, Meta.
Okay.
Must be my New York accent, Jason.
Well, I'm still looking to hear it as Facebook. So the name change, It's just I don't recognize it. So
I gotcha. Yeah.
Yeah, I don't really plan on living my life in the metaverse.
And it's not, nor do I. And it's not just tech. CBRE, which is probably the largest, if not one of the largest commercial real estate brokers, they're looking at reducing $400 million in cost, and I believe the bulk of that is going to be layoffs. So, this always has a ripple effect throughout the economy. You look at the GFC, and it was rate hikes right before that, and
well, actually, like Silicon Valley didn't have wide scale firings though during 2008. It wasn't, from speaking with a lot of the Silicon Valley people who either used to work there or still there. This is the worst tech bust since 1999, 2000. So this is more reminiscent of that. Actually, during the 2008 financial crisis, a lot of those firms online, they actually grew within a year or two. So there was some really big growth. That was the time during the 2008 crash to go and buy. So Amazon and Google and Facebook actually Facebook, I don't think was publicly traded back then. I think Facebook went
probably not
traded.
But even back during the tech bubble days, it didn't take long for the tech sector to recover and those big names like come up to prominence. And companies like eBay and Microsoft, they pretty much, while they sold off a bit, once that bottom, they were just off to the races again. And we've really seen a long secular bull market in tech for decades now, and I think it's ending.
There was a lot because of that bull market that you said, and these companies, a lot of these. And
the smaller, we used to call them bottle rocket companies, where they'd shoot up the IPO and then they would fall, and a lot of those just fell by the wayside. But that
was intentional. That was intentional, where the corporate insiders, the angel investors, the venture capitalists all wanted to dump their shares at the IPO onto the retail investor.
Yep.
It was not the old traditional IPO, say from many decades ago, where the company actually was going to raise capital to go and expand and grow and build property, plant, and equipment, hire a bunch of employees, build a new product or service, and grow the company like that. Actually, now
it was an exit strategy, no doubt about it.
Yeah.
And they hyped it up like, oh my God, I'm in the IPO. I remember saying, oh, I got in this IPO.
And the investment banks have to keep the shares manipulated high for a certain amount of time, but then there's a lockup. So when the lockup expires, so that's when you have companies like the marijuana company, Tilray, for those shares crashed. And then you had Beyond Meat, those shares, the insiders were dumping before the lockup. So you can tell these things. I mean, these companies are growth stories. By the time they're going IPO for a lot of these companies, their growth story is done.
Yeah, absolutely.
Because a lot of the value and the growth was already captured by the angel investors and the venture capitalists before it hit IPO. So the IPO structure has changed a lot over the decades, to where the company's not raising capital to grow. The insiders, all the vultures and the angel investors, are all doing the IPO to cash out, instead of where the company is going to actually raise the capital to invest in new property, plant, equipment, new products and services. So unfortunately, that's where Silicon Valley and Wall Street teamed up to screw over retail shareholders. And that structure changed a lot. But I think a main reason for this, Lee, there was a lot, because of the bull market, these tech companies were selling at much higher valuations, even though a lot of them really weren't tech businesses. They weren't a new technology. They were like a software website, a middleman. So they were a middleman, kind of like Uber. Uber is not exactly breakthrough technology. It's a middleman.
Well, look at Carvana.
Yeah. Well, Uber, my point though is that like Uber is not groundbreaking technology here.
No,
a lot of the Uber drivers, I mean, it's a taxi cab service. It's a middleman taxi cab service, where the Uber companies actually, like, they're a middleman, or eBay's a middleman for an online auction. So these middlemen are actually taking enormous cuts. But like, if you speak to Uber drivers, a lot of them weren't even making a lot of the costs back for gasoline and the other stuff. So it's not even profitable for a lot of these Uber drivers to be doing their job.
It's a terrible job. Those guys are making less than minimum wage.
Yeah. Meanwhile, a lot of these tech companies, like the mid-level employees, some of these product managers were doing no work and making six figures with stock options. Like the ones at Twitter, they were woke social justice warriors, and they were banning and blocking and financially ruining or getting people banned or removed from the platform and they weren't providing any value. So, I mean, a lot of the waste, fraud, corruption, and abuse in a bear market is going to be wiped clean. Yeah. And the valuations for a lot of these tech companies, I was seeing a Silicon Valley person tweet about how like all these cost cutting measures are going to be so good for the big tech companies. And I was like, well, the cost cutting isn't going to fix the growth narrative that a lot of these tech companies were trying to sell the investors for why they should pay way higher than normal multiples on non-profitable companies. So if you're trying to do normal business operations and just cut costs, which is what a prudent business would do in a recession, right? You would focus on cutting costs, improving profit margins. If your costs are rising, you're going to figure out how to lower costs. If you have employees that are wasteful and that are not providing any value, you're either going to fire them or you're going to reduce the amount of headcount, which is what a prudent business would do. The problem was these tech companies were so grossly overvalued, and they weren't even valued on free cash. A lot of them weren't even valued on free cash flow. They were selling at insane metrics on sales. Some of them were doing enormous amounts of accounting fraud and creating their own metrics.
The exact same stuff that was going on during the tech bubble.
Well, but my point though is that when they try to do normal business, normal prudent business functions of like in a recession, you're cutting expenses, you're not the investors who are paying insanely high multiples for growth. You cutting costs is not going to fix that false growth narrative that's gone.
No, because you're obviously not in growth mode if you're doing layoffs and everything.
Yes, and then you can't raise the easy equity capital, and then you're cleaning up your balance sheet, you're paying off debt, or maybe even you're taking on debt just to survive. So that easy equity there of buy high, sell higher, easy to raise capital from angel investors and venture capital next round. All we have to do is figure out ways to grow revenues and not focus on earnings. As long as there's growth, it could be sold to investors. You know, even the companies like SoftBank that were helping funding a lot of this stuff, SoftBank's in trouble now too, because they were using junk bond financing to buy these equity shares in Silicon Valley and Chinese tech companies. So SoftBank's in trouble too. Although they're, from speaking with hedge fund guys, they're doing accounting fraud. They're marking to model.
There's a lot of companies in trouble. Carvana is a very interesting story because their stock price was almost $400 a share, like $376. It's now $7.39.
And I would say it's a reasonable valuation, but there was a lot of people that paid when the chart was going up. They were paying much higher. Now, if you had bought out of the money puts in hindsight, you probably made a lot of money, or you had a long straddle or something like that when the shares were overvalued.
But I think that company's going out of business. And it reflects the price of used cars. I mean, you remember just a few months ago, they were going through the roof and they were hard to get. And they're just completely collapsing. And that is directly tied to rate hikes, because cost of financing cars goes up, just like it goes up for financing housing. And we're going to see, extreme softness in the housing and real estate markets.
Oh, yeah, I agree. And speaking of fake tech companies, when interest rates were lower, you had the tech companies, you had the fake tech companies that were real estate agent companies like Open Door, and what was the other real estate company? And they were actually flipping homes with cheap interest rates, but they weren't making a profit flipping homes. Yep. Even when interest rates were lower, they were still losing money at scale flipping homes.
It's amazing. It really is.
Zillow,
stuff that
Zillow.
Zillow, right.
The other so you have Zillow and Open Door. I think Open Door is down to $2 a share or something. So it's pricing in almost bankruptcy.
It's unbelievable.
Well,
just the stupidity that repeats from time to time.
Well, even Facebook or Meta now and Google, and those two guys, I tweeted this out 24 hours ago. They have a duopoly on almost all the paid advertising on the internet. So those are the two main controllers of almost all the paid advertising dollars, the large scale ones. So Google and Facebook, and they owned almost all the paid advertising, and they're even seeing enormous drops in advertising. So if they're hurting the ones that are not profitable, they're getting absolutely destroyed.
Yeah, as they should. It's creative destruction of capitalism, right?
Well, I don't know if I'd call what has happened the last since the 2008 financial crisis any capitalism. I'd say it's government. Yep. It's government and central banks.
Yep.
Flooding. It's the Cantillon effect. Creating
the central planners, man. They're trying to control everything.
Well, they've picked winners and losers. They've done tons of covert bailouts. So if you're a large hedge fund guy like a Ray Dalio or one of those guys, and you were doing the risk parity trade, or you're a portfolio manager, a bond portfolio manager at one of the large investment banks, and you have bad derivatives or bond trades on, you got bailed out. Maybe you got most of those guys didn't even get fired for years if they had bad trades. If you're a hedge fund manager and you get fired, they retire you to a family office. Well, a lot of those guys.
Well, yeah, because they've made so much money on their own just with all their bonuses and everything that they just established their own family office and invest their own money. You know, I mean,
it's the old Warren Buffett quote, right? So when they raise interest rates, you find out who's swimming naked when the tide goes out.
And we're finding out in a big way the past few months, aren't we?
And the answer is way too many people. And speaking of Warren Buffett, I mean, Berkshire Hathaway has enormous losses because he has a lot of investments in real estate, in insurance companies that have exposure to Europe, and these derivatives and bonds that are getting crushed. These insurance companies hold enormous amounts of bonds, and their value is getting absolutely destroyed when central banks raise interest rates. So this is Finance 101. Bond prices are inversely proportional to interest rates. So normally when interest rates go up, the existing value of the bonds, the principal value goes down. And if the firm was prudent and the Federal Reserve Bank doesn't have to adhere to generally accepted accounting principles, but we're seeing other central banks, Lee, like the Bank of England, the Reserve Bank of New Zealand, which we talked about 6 months ago, you're seeing these other central banks say we have losses on the bonds we bought during our quantitative easing, our bond buying programs. We have big losses, many billions, tens of billions or more in losses on the bonds we bought. The Federal Reserve Bank should have over $100 billion in bond losses. They're hemorrhaging cash at higher interest rates. They have to pay out all this cash to the reverse repo that's parked there, that the banks have parked there, and then all the cash that's parked at the excess reserves, the ER. I can't remember the abbreviation offhand, where all the excess reserves from all the QE programs are parked. So the Fed should have all these bond losses from raising interest rates. I mean, Warren Buffett's companies now, they have losses, although Warren is buying a lot more oil and energy companies. So I think like his oil and energy portfolio should do well.
Yeah, he has been for a long time heavily invested in the insurance space, and the insurance marketplace right now, it's really hardening. I mean, risks have gone up. We've had like some severe losses with hurricanes, and then their investment portfolio has been getting crushed with the interest rates. So it's a double whammy for the insurance industry.
Well, you don't think the Fed's going to print and do hidden covert off-balance sheet bailouts for some of these natural disasters that are $100 billion or more? I think the Fed probably has done a bunch of those. There's no way to prove or disprove this, but I think the Fed would secretly do that. I mean, these insurance companies, though, do have losses.
For like Swiss Re and...
Oh, I don't know if they're bailing out every single insurance company, but American...
Like AIG, maybe?
Well, for Hurricane Harvey in the Houston area, I think the damage was over $100 billion. There's been hurricanes that have caused immense amounts of damage and would have bankrupted a lot of insurance companies and other entities there. And I think the Fed just secretly did a lot of hidden bailouts because the state and local governments couldn't handle the emergency funds. But a lot of these insurance companies, Lee, I was sending you articles back and forth. These were articles on risk.net. So this is like an institutional investor website that has research articles on there. And they were talking about pension fund margin calls, and they were talking about energy derivatives that these insurance companies and reinsurance companies and pension funds, they were gambling on these things to try to make extra profits with leverage. And that's been causing intraday margin calls still. So even though we had the stock market rally, that's probably just an excuse while we had the stock market rally and the Fed and the Treasury were juicing more liquidity for these pension funds that had the margin calls to sell their profitable stocks to liquidate positions in, because they still need to, if they're getting intraday margin calls, they need that cash and they need to sell assets and go and raise cash and pay off the margin debt. They're not going to be buyers then of U.S. Treasuries.
No, definitely not. I mean, you have to realize, though, the way the markets trade, when you have a significant sell-off like we've had, people need to cover their short positions, and oftentimes that'll trigger a rally similar to what we've seen, and the same thing goes on in the bond market. People short bonds, and
Well,
then they have to buy them to cover. And
didn't you also you had a record amount of retail investors buying puts? So the last 6 to 8 weeks, I think over the last 8 weeks, you had retail investors just panic and buy insane amounts of puts. So that the large investment banks and hedge funds see all this data, and you know that they're going to figure out
they're going to fade the public. Absolutely.
How can we fleece the Muppets? How can we fleece the retail traders and make sure that those puts that they bought will not pay off?
Yep, definitely. Oh, and one interesting statistic, this is kind of out of the blue, but the housing market lost a record 1.3 trillion in equity in just the third quarter. So real estate market seems to be getting hit pretty hard. And I think that's a result of the layoffs and everything else. People just don't, and the interest rates, obviously, but people just don't have the money that they did.
And this will eventually trickle down over the next 6, 9, 12 months to problems with tax revenues.
Oh, no doubt about it. Yep.
So first, the consumer, it's not going to be property taxes first. It's going to be first the consumer, because they have record credit card debt from all their everyday bills are going up. The consumer is going to be cutting back on entertainment, on travel, on going out to eat and going out to eat at expensive restaurants, or going out to movies or other forms of entertainment, or going out drinking at bars or nightclubs. So those sales are going to fall. So sales tax revenues for those things are going to fall first. And it's going to start to cascade into other government tax receipts. And the governments are going to start to feel it. And this is why since 2008, 2009, the Fed has had to step in. And the Fed says they have these mandates. The Fed has claimed that QE's for other reasons. One of the main reasons, Lee, is because every time there's a recession or depression or a wide-scale crash, either in the real economy or asset prices, it blows an enormous hole in government tax receipts. So
is this why they hired so many IRS agents back in August? Some 87,000 new auditors. So they knew that they were going to be struggling for funds and needed to find some people to find money.
Maybe we'll see. We'll see maybe they're going after the crypto people who are doing all those crypto trades and not paying taxes.
Oh, how would you like to be making a living as a crypto trader now? The market has just completely collapsed. There's almost no volatility in Bitcoin or Ethereum or any of these. Just would not want to be trading that market.
Well, I'm seeing people tweet now that some of these crypto exchanges are close to failing. They're saying, some of these crypto experts saying, take your money off this exchange, take your, sell your crypto, move your crypto off of this exchange. This exchange is close to failing.
Well, they were making money off of the trades. And they were really charging an exorbitant amount of money to trade too. It's kind of crazy. I dabbled a little bit in Bitcoin and Ethereum and a few others with Coinbase, and I was astounded by how much it costs to actually trade them. I'm like, this is ridiculous. So now that revenue is all gone. There's no volatility. There's no one trading the market. So
this is what happens in a bear market. I mean, a lot of the crypto people have never been in a real market. A lot of the people that were trading the meme stocks and trading Bitcoin and crypto, they were never in a real bear market, like in the tech wreck or 2008, 2009, where people were begging for the Fed to come in and Jim Cramer was screaming, "They know nothing. They know nothing." Yeah. After he had been telling people on the radio, on his TV show that Bear Stearns was still a good buy a couple days before it failed.
Yeah, remember that
before
one?
It crashed. Yeah, well, it didn't fail. JP Morgan bought it at $1 or $2, so it didn't technically fail. JP Morgan bought it before it went bankrupt, but that was a shotgun wedding. From what I've read, JP Morgan didn't even Jamie Dimon didn't even want to buy it, and then Bear Stearns had that enormous silver short position. That was one of the main reasons why.
I don't know if you ever seen the movie Wall Street, the 87 film.
Oh yeah.
You look at the stock price movement back then. It's minuscule compared to what stocks move today. And the market's going to go back to that. We're going to collapse. And that was a bull market, but we'll probably go back to where stocks don't really move much at all for months on end, maybe years on end. They just kind of stay flat. They'll go up a little bit, go down a little bit. We're just going to see a collapse in volatility, I believe.
Well, it depends what happens with the currencies. I mean, if the US dollar, if what happens to the if what happens to the Japanese yen over the last 12 months happens to the US dollar in the next 18 to 24 months, I mean, if the dollar gets devalued a lot, everything's going to go up in price, but it's not going to be beneficial to the average person. I mean, like
No, of
one of
course
the
not.
highest
Yeah.
performing stock markets in the past was the Venezuelan stock market or the Zimbabwean stock market, and that was in nominal value. So
Yeah.
even though the stock market on a percentage term went up enormously, you lost most of your total purchasing power because of currency debasement and monetary inflation, and the government was abusing the currency.
Yeah, of course.
So a lot depends on the currency. Right now, the dollar is strong relative to the other garbage fiat currencies, but they're all garbage.
Do you have any thoughts on the Japanese market? I know we talked about them manipulating things, and
we discussed this in the past. So things were working okay for Japan for a while because they could export a lot of their inflation, and they were able to run trade surpluses and buy U.S. treasuries. And now they're not. Their firms are not running trade. Their country and their firms are not running trade surpluses. They have to import enormous amounts of energy. They're talking about restarting their nuclear power plants. So that's going away. It looks like they've had to sell some U.S. treasuries. They're having to defend their currency. I said this at the beginning of the show that historically, financial history and governments, a lot of governments have been able to get to ignore these rules for a while, but it looks like finally things are getting close to back to the normal for financial history over hundreds of years. Historically, governments and central banks have not been able to protect both their government bonds
no.
and their currencies together. So they've had to choose. So
Once again, it's the delusion of central planners thinking that they can control things, and they really can't.
And so this is finally the end of the road then, Lee,
Yep.
for Japan, where they've had to choose between intervening in their government bond market to protect their government bonds versus their currency. They cannot say both.
And the Fed is in a very similar situation where they're just boxed in.
Of their own making. So
Yep.
right now, the dollar looks strong, and on a relative basis, the US looks a lot. Things don't look nearly as bad in the US compared to a lot of other places. Yeah, there's bad stagflation here. Yeah, a lot of companies look like they're downsizing and firing. Things are a lot worse than a lot of other countries.
But you sure wouldn't want to be in Europe or Japan or any of these other countries where it's a lot worse.
Oh, an extra $1,000 a month on my energy or electricity bill would be absolutely horrible for me.
Yep, no doubt about it. Is there anything else you wanted to cover tonight, Jason?
Yeah, we wanted to talk about gold and silver really quick.
Oh, right.
So,
okay.
yeah, we wanted to talk about the insane premiums on silver. Also, the gold numbers that we're seeing, Lee, in the third quarter of 2022, we had the largest purchases of central bank gold buying in terms of net tonnage since 1967. That was when the London gold manipulation pool was ending. So, despite strong dollar, despite rate hikes, the countries that do have cash, that are running some trade surpluses, they are buying more gold.
So do you think that the spot market is being manipulated so that these governments can acquire?
It would not surprise me. It depends if they hired a bullion bank to move them the tonnage. So the bullion bank would then make the commission to either drain GLD or to manipulate the spot price down, and they would get their commission if they move the tonnage to the central bank then at the lowest possible price. So the central bank, the bullion banks make their enormous commissions filling these orders for the central banks as some of their largest customers.
I would imagine it would be their largest customer base.
Well, but also the private demand for physical gold in India, in Turkey, China. I mean, the premiums in a lot of these countries are still trending higher. They're
insane here, Jason. I mean,
well, for silver, yeah. For the gold premiums are not super high compared to a lot of other countries.
True, but compared to what they were a few years ago, they're insane. And you speak with any of these bullion dealers, and the supply is so tight. Demand has been so strong and we're going over a year now that the demand has been crazy at the retail physical marketplace.
Well, for silver, I mean, a lot of it is based off how inefficiently run the U.S. Mint is.
Mm-hmm.
So if you want silver eagles, you're going to pay all these extra fees that are added. So you're going to pay the authorized purchasers all those extra fees that are the US Mint adds extra costs on. So they have a guaranteed profit. The authorized purchasers add extra. There's a ton of extra middleman fees that are tacked onto the price of a Silver Eagle before you, the retail investor, go to a bullion dealer either in person or on the website on AppMex or JM Bullion or SD Bullion or any of the other ones.
I'm looking at the JM Bullion website right now, and Canadian Maple Leafs are at 31.31. Their lowest price. I mean, that's a huge premium.
Let's see what the spot silver. And spot silver is at $20.68. So
right.
That's $9.
It's over.
Yeah, over $9 an ounce premium.
Yeah, so there you go.
I would personally be looking at bars then and seeing if I could get bars for $2 or $3 an ounce premiums. So that would be on a relative basis, that would be cheaper rather than paying sky high premiums for Eagles.
Oh, I've been buying bars for the past year. I won't touch anything. I mean, I have a bunch of the the Maple Leafs and the Eagles and the Krugerrands, just collecting them. But I've been buying like just because the premiums have been so ridiculous. So here's an ounce bar on the JM Bullion website for $26.90, and that's still a pretty crazy premium. It's over $6, on a $20 item. That's a big percentage.
There's not going to be a lot of help on the supply side. I just put out articles for patrons on this. I mean, Newmont Mining, and they do an enormous amount of low-grade open pit mining of copper and gold mines. They're one of the largest copper and gold miners in the world. Some of the half of their mines, Lee, their costs are over $1,500 an ounce.
Yeah. They're facing the same issues every other business in the world is right now. High energy costs, high transportation costs.
Miners even more so because
they're heavy users of energy.
Well, you're moving basically uneconomic rock, and you're tossing the rock in a giant Caterpillar earth mover or one of the other companies' 2-ton trucks. You're using tons of diesel 24/7, 365. You're putting it on a conveyor belt to a crusher. And then that's using enormous amounts of electricity. Or if it's in the middle of nowhere and there is no electrical power plant, you're using diesel generators. So you're burning diesel there like crazy too. And then you're using tons of energy and chemicals to separate that uneconomic rock for 1 gram a ton gold or lower, and then try to get economic ore. And the copper grades are not good either.
If anyone's ever watched the show Gold Rush, they've got an idea of what the process involved is and how intensive it is.
Okay, so that's not a.
And those are small. Those are small little mines. They're not big commercial producers.
And some of those guys are risking their lives to mine. No, we're talking like wide scale mining on an open pit mine where like there was a mountain and then they carved into the mountain. And basically they're moving tons of rock that has almost no copper or gold in it, and they're crushing it down to a pulp, to a fine little powder, and then they're using enormous amounts of energy and chemicals to separate it out.
Process it,
Yes, and then to get those tiny amounts of copper and gold and silver together and reliquefy them, and then melt them back into a doré bar.
Yeah, no, I was just trying to make a point. Like, if you've seen that show, you have some clue. It's not the same as large commercial scale mining that you're talking about, but it gives you a hint of what the process is,
Oh, the large scale stuff is burning even more. So you can maybe get lucky at a small mine and find like large gold nuggets. Still, if you're those guys, what were diving and they're risking their lives. But we're at the large scale mining, I mean, the grades of copper and gold and silver are super low. The grades just get worse every 5 to 7 years. I did an article on this for patrons. I mean, Pan American Silver, their silver grades less than 10 years ago were about double what they are now. I mean, the grades have fallen off a cliff for silver.
Oh, yeah, no doubt about it. I mean, have you ever seen those trucks that they use in the large scale mining? Can you imagine the fuel costs of running those things for just a mile?
And those things have to run. There's a day crew and a night crew, and
they run 24/7. Yeah.
Yeah. So the night crew is still burning diesel, and those tires, it depends really on the market conditions. But at one point, when this was back in, I think 2011, when gold hit 1900 for the first time, those tire prices on those large trucks, it went from like $5,000 a tire up to $20,000 or $30,000 a tire, and they burn through those tires very, very quickly. I don't think some of those tires don't even last a week or two.
Wow. Wow, that's pretty insane.
Yeah, so they're running these trucks, they're burning these tires. So the cost of these miners, they can't control all these. And people like, oh, they should hedge this. Oh, they should lock it in. Agnico Eagle tried to do some hedging, and they had 150 million in losses. Yeah, so they had 150 million on their hedge book in losses, based on the dollar rallying, because I think they tried to do some currency hedging, and then also they had bad oil and diesel hedging. So overall, I wrote an article on this. Overall, Agnico Eagle, their operations at their gold mines were solid, but then they had a problem. The loss was from their hedge book, because everyone was telling them, you need to hedge this, you need to hedge that. Well, they tried, and then they
And
screwed
it didn't
up
work.
anyway.
Hedging is very complex, and it's gambling, really, because you don't know exactly what's going to happen. And anyway,
just because hedging is complex, like you said, and just because you try to do something doesn't mean it's gonna, in theory, just because it sounds good doesn't mean it's gonna work out well in practice.
No, it's just like someone learning the trade. I mean, you can buy puts and be right on the market, but the timing's off. And it's the same thing with hedging. So.
Yeah, and historically, Lee, you traded on Wall Street. I mean, historically, most people who do a lot of shorting don't make a lot of money.
It's very, very difficult because it's easy to buy and hold like a longer term when you're long, because the moves happen in so quickly, and when you're falling. I mean, when the market's collapsing, it happens so quickly, and then it bounces. So you just, it's a real skill. Anyway.
Okay, so in wrapping things up here for episode number 12 of Finance Unspun, Lee, anything you want to talk about with the elections that are going to occur tomorrow here in the United States, the midterms, the congressional elections, or do you want to talk about maybe any sectors you think are interesting? I disclosed before we started recording, I was saying I think the fertilizer companies, for Canadian and American ones, I think with a cheaper,
I think especially American, and what was the one that you mentioned? Nutrien, right?
Yeah. Well, Nutrien used to be Potash Corp. So Nutrien, Mosaic, and Intrepid Potash, I think, like, because the European Union, their natural gas prices are still very high, they're going to have to import a ton more fertilizer. So the American ones look like they have an advantage. The cheaper natural gas, liquefied natural gas companies here long-term still have an advantage here in the United States. There's not a lot of countries that can actually increase oil and natural gas production. You're seeing the numbers from a lot of these OPEC plus countries starting in August. They crapped out. I mean, they couldn't increase production. So like when Biden got mad at OPEC for announcing production cuts, the production cuts, Lee, had already happened. They happened in August because a lot of the OPEC producers couldn't increase production anymore. They maxed out, and the production started falling by almost 4 million barrels per day on its own. So the production cuts that were announced were basically like, oh, our production fell, and by the way, we're announcing production cuts. So the announcement of the production cuts was a moot point. That's my point.
Well, I think classic bear market plays are still good, like consumer staples, healthcare. Just I would be staying away from tech unless you're shorting and really good at it. I'd be staying away from real estate. Anything that has been driven by interest rate cuts for the past 10, 20 years, that's where you want to avoid.
And I think there's still a lot of supply side problems. Lee, actually, if things continue the way they are, what we're seeing in the earnings calls with much higher costs, paper commodities, futures contracts falling, I mean, we could have over the next 6, 9, 12 months, supply destruction faster than demand destruction. So at the same time, and that would be a total chaos scenario. That might be similar to what happened in the first couple of quarters of 2020, where a lot more supply comes offline because the producers of these base metals, the supply chain companies that are dealing with energy costs spiking and base metals, you're seeing in Germany, Lee, I discussed this with Doomberg, you saw soap manufacturer, and so a lot of soap manufacturers, unless you're buying fully organic soap, the majority of soap manufacturers use a ton of petroleum products. One of the largest ones for 120 years in Germany just went insolvent. You're seeing BASF, which is an enormous plastics and chemical company in Germany, because their energy costs,
one of the largest in the world.
Yeah, so their input costs for natural gas and natural gas liquids, energy to make chemicals, to make plastics, are so high they can't compete in Germany anymore. They're going to have to leave.
I would probably be focused.
These look like supply problems to me.
No doubt. But what I was going to say is I would probably be focusing on domestic investments in this scenario, because as things go, we're the best of the worst, if you will.
Well, I always ask myself also, what's cheap, what's hated, what's down 30, 40,
Right.
50% or more, what could rally? I mean, we've had a nice little pop recently in some of the copper and base metal companies. I don't think the rally is permanent yet, but I think like these things will start to put in a bottom, because what I'm seeing with the earnings call and the conferences is these companies, their margins, they don't have margins anymore. So a lot of these copper and base metal companies went cash flow negative over 8 weeks ago. The gold mining companies, so you're like a lot of these large open pit gold miners like Newmont and others, if gold prices right now, if they go another $100-$150 lower, a lot of these open pit gold minings, they're not economic. They're going to be running at losses. So I think we're going to have a bottom soon in gold. But the central buying, excuse me, I'm still sticking with my call that in under 6 months we're going to have a bottom in paper gold prices. I think
one interesting contrast between tech and mining is that mining companies run extremely lean. They're not like tech companies where they're just throwing money at stuff. I mean, they've been forced from decades of operation to always run extremely lean. Costs are going up and they've been getting impacted by that, but it's not like they run with a lot of fat within their company. Would you agree?
They're still inefficiently run. So if they were lean, they would have better profit margins. There's just certain costly that can't be avoided. The problem is a lot of
understood, but I'm just saying that they're very different from tech. They're like the polar opposite when it comes to.
So what I would call lean companies are the royalty companies, where like at Franco-Nevada, you have like 40 employees, or Sandstorm Gold, you have like 20 something employees, or Wheaton Precious Metals, you have 35, 40 employees, or Royal Gold, you have 40 employees. And you have tons of free cash flow. So those are like lean operations. So
there's no doubt that these big mining companies have huge overhead costs. There's no getting around that. It's just the nature of the beast.
Well, also with the mining companies too, you have in these emerging markets, you have a lot of the mining workers, they want higher wages to offset inflation. So that is not priced in yet for the profit margins, and the cost for these miners is a lot of these operations at the mines, the wages are going to have to go up soon. So that's going to hurt margins even more. Another argument that either supply is going to come offline soon or metals prices are going to have to go higher.
I can't see how, and it's astounding to me that we've had these high premiums in silver and even gold when you go back historically, and the demand is there at the retail level, but the price of the physical metal it's been consolidating for a long time.
Paper price manipulation, man.
Yeah, it's due to start ripping. It really is due. It's long overdue, actually.
It's control of the prices through the GLD and SLV. So a lot of the institutional money goes into these metals trusts that don't really have the metal, like GLD and SLV. So a lot of the capital goes in there. And then a lot of these derivatives in London and the COMEX. On the LBMA and COMEX, there's insane amounts of derivatives for gold and silver. They're some of the largest ones. They're way larger than a lot of other commodities.
Oh, no doubt about it. Well, I think we pretty much covered everything, Jason. It was a very fascinating discussion as always.
Yep. We didn't talk about anything about the elections. I expect... we'll release this before. I expect the Republicans here in the United States will gain a significant amount more seats in the House. However, I do not think that it will fix the energy problems. So I think like Biden and the regulatory agencies that him and his buddies control, they will continue to block a lot of the pipelines, oil, natural gas drilling, potentially building any new refineries. So I do not expect a ton of new supply, oil and natural gas supply, to come online if Republicans do win a bunch of seats in the House of Representatives.
I will make one election prediction, and that is that Biden will no longer tap the Strategic Petroleum Reserve to lower prices going forward.
Do you think then that the more Republicans in the House could threaten to, under national security, to bring impeachment charges or something like that?
No, I just think that there's no motivation for him to do it anymore because the election is going to be over.
I mean, theoretically...
And this is especially true if Republicans do take charge, because then the Democrats can go and point fingers. Well, you see what happened to the price of oil after they got in. So.
Well, I mean, theoretically, Biden could still continue to dump SPR oil. It's just that now there's people in Congress that could threaten to bring charges against him. I don't know, though. A lot of the Republicans are so spineless, and they're so content with getting large checks from the military-industrial complex. And both parties are like, "Oh joy, Ukraine's getting all this extra aid on Fridays at 6 p.m. every single Friday. Press release every single Friday. Press release. Ukraine gets more."
Nothing like burying a story by releasing it on a Friday afternoon.
It's been
they've been doing that for decades.
Well, but it's been like that almost every Friday, Lee, for months now, where Ukraine just gets more aid packages to buy more weapons. It's like the parasites here in the DC metro area are just getting rich, fat, and happy off this stuff, off the corruption and graft.
Oh, that's what DC is all about. You know that better than anyone else, right?
And this goes back to the treasury market here as we wrap things up with episode number 12 of Finance Unspun. There are a lot of problems, lack of demand, especially foreign demand for U.S. treasuries. So there's only a certain amount of groups of buyers left. So it's either the Fed buys them off balance sheet or reverses quantitative tightening and does QE. So that's one. Or the rules are changed as we discussed with Jim Rickard, as I discussed in my interview with Jim Rickards, or what David McElvaney said last week in his interview, that the rules are changed so the large banks here in the U.S., so they can buy more treasuries. So they'd have to change some of the rules so the banks could go to from 10% of their balance sheet of U.S. treasuries to 40%, like in the past decades ago. Or they force people in their retirement accounts here in the United States to buy U.S. treasuries, and then the debt gets inflated away because the people here in D.C., both political parties, Republicans and Democrats, they don't. There are so few people, Lee, that are talking about reducing spending. It is insane. The majority of people, both parties, Republican, Democrats, they all have their spending increase plans. They all have their pet projects, or they're willing
of course, that's the way the world works, unfortunately.
Well, or they're willing to make trades for votes. So they're willing to do deals. You can have my vote if I get this spending package. And then that's how things get done, unfortunately, here. A lot of things get done, unfortunately, here in DC.
Yeah, and we get screwed by the whole process, but there's not much we can do about it because no matter who we seem to vote for, the same thing just continues.
And the parasite in the DC metro area is destroying the host, which is the real economy and the savings and purchasing power of everyday Americans and small businesses.
Jason, thank you so much for the discussion. It's been great as always.